Welcome, everyone. I'm sure you had a very long day at IFX and you're ready for another insightful panel. We're going to start with risk management today. And firstly, I'm going to ask our panelists to introduce themselves just for a few seconds, so 30 seconds. Yeah, there you go.
Thanks very much. I'm Matt Maloney. I'm the Chief Executive of Edgewater Markets Limited. So we're a UK FCA and Mauritius regulated broker, multi-product strategy, and we only onboard institutional customers. So we don't have a retail business ourselves. Looking to grow across the world. So that's why we're here to talk.
Hi, everybody. I'm Bailey White. I'm the Global Head of Trading at TMGM or Trademax. So we're a retail CFD broker. Yeah, that's it.
Hello everyone, I'm Giannis Nikola. I'm the Chief Risk Officer at Easy Markets, a retail broker company that is this year we will celebrate our 25 years in the industry. Thank you very much, Elina, and your boss for the invitation to be part of this panel among colleagues and industry experts, and I hope everyone will enjoy it.
Hello everyone, I'm Marios, CEO at LP Prime, multi-asset liquidity provider. We also run only institutional business. I'm glad to be here. Hopefully this is going to be an interesting panel.
Thank you very much. I think we have a mixture of institutional retail, which is always very exciting. Okay, so to start off, I think 2026 has been exciting and eventful already. I'm just wondering, from your perspective, what market events have represented the biggest liquidity risk in 2026 and what is yet to come? So I'm gonna start with you, Matt, because you're the closest to me.
Thank you. That's a privilege. So look, I think that the continued concentration that we have seen and that growing concentration in precious metals poses a very significant risk, and that's I think why depth of liquidity and that constant ability to source liquidity, at challenging times, whether that's in the spot market, the futures market, or even in the swaps market, is absolutely imperative. And I think that's something that we probably all share. There have been some fairly challenging moments, but that constant drive into just one product. So our customers don't necessarily have balanced portfolios. The banks and LPs that some of us deal with don't necessarily have balanced portfolios, has presented moments of challenge and risk. And I think it's incumbent on all of us to try to offer to our customers a broader suite of products so that we can help to diversify their risk and that we can help to diversify our own risk to a certain extent.
Yeah, I think 2026 has been pretty eventful. So I hope the worst of the liquidity events are behind us. But I do think, obviously the developments with US and Iran, what happens over the next few weeks will be a key moment. But if I was to be a bit, contrarian and say what is the biggest risk, I do think the AI bubble, if I can call it that, is probably quite a big risk for a lot of retail brokers. If things change, if the tide turns with the valuations that AI companies are getting given and obviously more IPOs slated for later this year, I think that could be quite a big liquidity risk.
Did you get affected by the SpaceX IPO or any other IPO? Did you offer it?
We did offer it on launch, not pre-IPO. Some brokers were brave enough to offer it pre-IPO, but not us. And yeah, it is quite a big risk. It's quite a one-way risk. And I guess my personal opinion on the race being run, it's probably more of a downside risk at the moment for AI in general rather than an upside risk. But again, just being contrarian.
The biggest risk so far for our retail business, the ongoing geopolitical tension that is going on with the Strait of Hormuz, open, close. We see an increase in the energy market, and we see a concentration of traders, meaning they are trading single directional, going long on gold, on energies, and we see this concentration be a very big risk, especially for retail brokers. Again, like my colleagues mentioned, the AI bubble, and of course the risk from ongoing IPOs like SpaceX. We already launched it as CFD also, so that is for me.
Yeah, it's been an eventful year. We had the disruption on CME. We also monitor the situation with the geopolitical tensions that we've seen around. everything has been reflected on spreads. Spreads are wider, margins are higher, credit lines are shrinking. You need to post much larger collaterals than the previous year. CME has changed the requirements on margin. So it's going to be interesting. It's affecting liquidity, spreads, etc. So everyone needs to be cautious. Hopefully the situation will soften, but let's be optimistic.
It's more of a question to you and Matt. So I'm more interested in the disconnect between the pricing of, well, let's say gold on the CME or whatnot, and whatever you offer to retail brokers. So how do you manage that? How do you manage that risk?
Well, as you know, different venues use different references. Some people are pricing from EBS. The vast majority of the counterparties are pricing from CME using the fair valuation policy. If the trading is disrupted, there is nothing that you can do. Unfortunately, people cannot get outside their trades. In my humble opinion, the biggest concern is the spreads that we got to see when pricing resumed, $20, $13. That's very difficult to explain to the retail world what's happening there, and also showed the difference between liquid providers and where they are pricing from and what's the reference. Providers that are more banking oriented or with a banking mentality have different approach. More prime of primes have another approach. So it gave us at least a very hard time explaining to people what's been happening.
Yeah, I think that's very, very broadly correct. I think the other point that we have certainly found useful is to really know our customers, right? And to segment those customers and to give them risk profiles and to ensure that there's a constant dialogue so that we are happy with their margining levels, that we're happy that they are sending diverse flow to us. And then on the flip side, that anybody we deal with in the primary markets, our tier one prime brokers, have again got very strong balance sheets and they are able to withstand shocks. Okay, there is no point us placing millions and millions of dollars with people where we believe there might be a risk, where they may not retain our funds one day. So the industry starts to coalesce around a sort of smaller number of people that are well funded, well capitalized, and have got that essentially very, very deep liquidity, and are able to withstand these shocks, so that if there is a $20 issue or there's an outage, there is pricing coming from multiple sources that can be executed in depth and with great rapidity.
But is it more about how do you exit your position if you have to?
Yeah, absolutely. Yes, and there are some people out there that are offering spreads that frankly are unbelievable, right? But you have to ask yourself, are they real? If I actually need that spread, can I execute on it? Yeah.
If I may add, the most important thing is if I make profit, am I going to withdraw at the end of the day? Having these kind of spreads.
Yeah, I think from the retail side as well, obviously in the last year, we have seen that divergence between what retail brokers and retail clients are expecting to execute at, particularly when it comes to gold. The expectation is still there at 10 cents or sub 10 cents. But a lot of what happened was a combination of two events. Gold asset price increasing, LPs naturally widened to retain their dollar per million yield that they expect. And then we also had the volatility. So it was two events happening at the same time, which led to that experience. I think it's not a problem for institutional side brokers or prime primes to solve. It's for retail brokers to solve. We're the ones with taking most of the warehouse risk. We're the ones that should own what spreads we execute against our clients at. I think that's the answer to the question.
From a retail point of view, of course. Again, I've been approached many times from a lot of liquidity providers offering these unreasonable spreads. For my opinion and due to my experience, we saw that the most reliable liquidity provider is the one that offers you deeper liquidity on tier 2 levels, tier 3 levels. So that's where we are aiming to have a good cooperation with an LP.
I think this is a very good point. And now that as we see, it's impossible to exit those positions because the conditions you offer to your traders are very different from what you can get from Edgewater, for example. AB book model or hybrid model still relevant, or how would you operate a broker today? Is it changing? Is it the same?
I think most brokers now are running a hybrid model, so I don't think you can put it into a class of A/B book. There definitely needs to be a layer of hedging and a hedging overlay to everything you're doing on the internalization side. But for sure, it means that the risk reward of hedging more, that equation changes as the hedge cost changes. In terms of the, I guess, classic A book, B book, the idea of profiling end client traders is still very relevant for a broker's internalization process. And then separately, I think the risk management and hedging side is a little bit different. And I think that's what adjusts according to hedge costs and the, I guess, market environment and risk situation.
How do you profile, like personally?
How do we profile? I think most brokers do the same thing. Look at markouts, look at P&L profitability. You look at kind of the risk taking of a certain client. Obviously, you're looking for certain abusive strategies as well that they might be running. All those kind of classic things.
I believe nowadays QRA book models, QRB book models are dead, on my opinion. So again, we are running a hybrid model. This hybrid model is basically on client segmentation, as you already mentioned. We have dynamic routing, so we dynamically routing our profitable clients or our toxic clients to the relevant flow, and also dynamic risk management. You have to constantly monitor your net exposures, your limitations, whatever is excess your limitations, send it for hedge.
Well, I think, yeah, pure A book, A or B book model is nowadays obsolete now. It all depends also on the balance sheet, on the target of the retail broker that they have. If you are pure Asian flow, if it's European or whatever, you take on a different approach. So it all depends on the profile of your clients that you accommodate. If you compete on tight spreads, for example, then there is not much that you can do. Apart from the markups or whatever, you also need to take into consideration the size of the balance sheet, whether you can accommodate the risk. Of course, statistically speaking, the P&L should be regressing towards what you charge the clients. So it needs to be dynamic, bearing in mind that the following day you have to pay your clients, you have to pay for the expenses, etc. So dynamic approach, I think it's what we'll be seeing in the future from now.
Maybe sitting on the institutional side, yeah, I echo all of that. Right. Absolutely 100%. It's about having a good relationship with your LP. It's about stratifying each of the clients. It's about giving them maybe different terms. There's got to be an expectation that if a retail client is sending very sharp flow, then the spread is not necessarily going to be sort of 5 cents or wide or day long. Yeah, so there's an entire process of education that goes right then down to the retail client.
So I've actually looked at some statistics recently, well, yesterday, and I looked at the asset classes that's been trading in June, not May. And an interesting thing that I've noticed was that the gold trading had reduced. So when we were in some of the months, it was 89% at the West months. Now it's down to under 60, and the indices are, the trading in indices is increasing. We had a spike in cryptos. It went from 3% to 10%, and of course, like crude and so on. Are you seeing the same tendency this month? And do you think it's going to continue? What's your view on that?
Yes, we're certainly seeing a far more diverse flow coming through from our customers, absolutely. And a big part of the kind of strategy is to be able to offer multiple products to multiple people, geographically, multiple customer types. So yeah, absolutely, we're really seeing that, and it's something that we are very keen to enable. Yeah, absolutely.
I think we are seeing that, but probably to a reduced extent versus the stats that you just quoted. I think most of that is probably driven by what's happening with gold and also what's happening with the IPOs and the interest in particularly US equities market. So not only have we seen indices spike, but we've also seen single stocks volume spike. And I think a lot of that is driven off the retail interest in those big names and what's happening with AI stocks, as I mentioned before.
I will add not the last month, the last 2 months.
Okay.
We saw a decrease in the volumes of gold, especially from retail side. We have a significant increase in the energy trading, oil, especially what's going on with the Strait of Hormuz. Also, a lot of interest in indices, and of course, the IPOs that are SpaceX, the major event of the last couple of days.
Yeah, same here. Gold has decreased, indices, futures. At least we started seeing a much more diversified flow than the previous month. So hopefully this is going to continue as it creates a much more healthy portfolio of products.
Just by looking at or comparing 2025 and 2026, how do you think the patterns of traders have changed, if they have changed? And is it more difficult to warehouse, or is it easier to warehouse? So what are the trends in trading, so to say?
For sure, the profile has changed, and the reason is due to the fact that we have had some shocks in the retail space, at least. A lot of brokers, by warehousing much of their flow, didn't manage to survive or anything. So people not getting paid or whatever drove the clients into different products, different providers. So things have changed. Also, the brokers decided to change the conditions they offer to their clients. I think we are moving from the swap-free conditions or whatever away. So due to the recent shocks, the pattern has changed. I think people started becoming more rational in what they are offering, what they have been asking. I think I speak for all of us.
I had the same discussion a couple of weeks ago with some colleagues, and we were discussing that the last couple of years we saw that retail traders become more sophisticated with the use of AI, trading strategies. We see an increase in the high-frequency traders. They are trying to abuse every fault of the system, latency arbitrage, especially flow from a certain region of the world. Also, we can see lately that, that the traders are concentrating on macro events. They are going single direction, long gold, long energies. And we notice a huge demand on copy trading, PAMM trading. Now with the increase of the social media, they are looking for signals. People, they don't want to trade by themselves. They want to trust a random signal. So there is a huge demand for copy trading and PAMM trading.
Thanks. If I was to add one thing to what they said, I think something that we are seeing a little bit more of now, and I think it probably relates to the increased, accessibility of retail trading in general across the world, and also social media and a new generation of traders coming through. I think we're seeing more events where there is coordinated trade ideas being taken by clients. So I guess the first best example of that would be GameStop. Yeah. I think we're seeing more cases of similar ideas. For example, short oil after US-Iran war blowout. Things like long positions in similar stocks, like AI stocks. I think there's more coordinated activity, not necessarily in a bad way, just that. Not necessarily copy trading, just people replicating the same ideas because those ideas are being shared across social media. And I think that poses a risk to retail brokers because they're going into, more niche areas, right? Same side positions in single stocks for a retail broker is probably a very new experience compared to the diversified flow that they get in something like gold or FX. And if they run the same risk models that they run in other products, they could get run over.
Yeah, and I think that we're probably seeing a little bit more restraint from a lot of the retail customers as well. Macroeconomic events have led to some outsized returns and some outsized losses. And people are maybe a little bit more willing to adopt careful risk management techniques so that they can manage on both sides.
With copy trading, I think, and again, I'm just curious more on the retail side of things. Again, the liquidity needs to be sourced very carefully because if you know that you have a master who executes a specific strategy and then you have hundreds of traders following it, you're just going to wipe out the whole book. So how do you manage that? How do you manage your liquidity for retail traders?
Yep, that's another one where I think the retail space needs to step in rather than relying on the institutional counterparties. So they need to be the ones, determining what the spread and execution cost is for that type of flow, and designing the technology on their side to support that. I guess either the retail broker or the copy trading provider, I think, needs to step in there, and that's what we do on our side.
Limitation has to be in place. So you are monitoring constantly your net exposure. You set your thresholds. If the thresholds move above a certain level, you send this to the external provider. Of course, as you mentioned, you have to have a good relationship with your liquidity providers in order to accommodate this kind of flow. And also you have to have your tools that will constantly monitor the activity from this kind of, let's say, master traders.
No, right? the thing is that copy trading and PAMM are two different things. Copy trading creates multiple orders, whereas PAMM creates one single order that might be swept across the book, etc. So the challenge for the retail broker is to explain or manage the multiple trades coming from all these copy trading, because you might have 100 trades, the top of the book might be, exactly. Then you have to move to the next level, and that creates different execution across different clients. This is where technology steps in. That's a challenge, I think, with this kind of models, rather than the ambiguous, because if you execute different trades on different levels, you somehow manage any latency attempt, but that's a huge challenge, though.
Your liquidity providers should be able to facilitate that, right? It's about a dialogue. It's about knowing the shape and the flavor of your customers and what's coming. There's a price for it, but it's something that should be able to be facilitated quite easily, even in an STP environment, straight through to an LP that's got good depth and good market coverage. So,
yes, but when you have multiple orders and the order book updates every 5-10 milliseconds, and there is no throttling in place, then you understand that multiple trades cannot be filled at the same price, right?
That's exactly it. Yes, there's a price for doing it.
Problem, though.
Yeah.
Now, question for you guys now. So, how do you accommodate, let's say, a retail broker that wants to tell you that I'm gonna send 100 orders, and I want to deliver liquidity or higher top of the book volume? How do you have let's say, a solution for this kind of trading activities, or you are diversing this kind of flow? How do you deal with it?
No, if you want, I don't know, 1,000 ounce top of book, 5,000 ounce top of book, talk about it, right? If we know it's coming, we can set it up and we can price it. You can have a look at it and see if it works.
You are creating pools for this specific kind of trading activity?
Absolutely.
With higher top of the book volumes.
Absolutely.
And deeper liquidity.
Yep, deeper liquidity. Ultimately, if you're sending it out, let's say to a tier one, to your PB, have that discussion with them about what might potentially be coming. Yeah.
Yeah, but higher top of the book comes with at a higher cost.
I know.
Of course, there needs to be a discussion with the LP. You get some trading there, you create a pool that is suitable to their needs, but there are always trade-offs to customizable solutions. So I would say that the best approach is to have an honest conversation with your counterparties, create a solution that is suitable to you, be comfortable with it, and trade.
Thank you. I just want to ask a little bit about the tools that you've described. So you said, yes, you would look at markouts, which is reasonable. I'm also wondering, do you benchmark your flow? Like, do you know what you expect from your flow? And do you put any standard deviation on it in terms of like, what would I see as toxic? It may not be necessarily toxic, but are you running any benchmarks on that?
It's a great question. So yes, we broadly know if we onboard a retail broker, kind of what to expect. But obviously everybody's markouts, everybody's flow is very different. So it's looking at how that flow evolves over time, and it's having a sensible conversation with the liquidity manager at that retail broker to see if, I don't know, 3, 4, 5 different segregated liquidity pools might be more appropriate than just throwing everything down one channel and hoping for the best.
Yeah, we definitely do benchmark. I think the main thing is obviously looking at what your spread you're charging, which is shown by the market as well, and then comparing it to your historical averages. In terms of, I guess, identifying toxic flow, that is a huge challenge because it's not as simple as you see red on a markout and it's toxic, right? A lot of very benign flow can look toxic in the short term or even in the long term with certain different trading strategies. For example, a martingale strategy. So it's not that simple. There need to be other factors that you add into market and mark-out analysis. But ultimately, the key thing in terms of determining is it toxic, is it not toxic, is really statistical significance. Do you have a large enough sample size? Do you have enough independent trades to determine whether the market going in a client's favor is abnormal or it's just randomness?
We are using a client scoring system, an automated client scoring system that follows. One of the most important things is markout analysis, of course. We analyze the behavior of the client. If they are trading during liquid hours, we have many reports that are sending us alerts about this. We have scalping reports, we have HFT reports. All this in a combination, we are combining a score, and we know how to classify this client if a toxic or not. Again, a markout report solely cannot give us a clear answer, but let's be honest, we are in the industry for many years. We know a certain pattern that clients are coming from specific regions. They are depositing with specific way. They are not answering phones. There is a pattern. We are creating, let's say, an algorithm behind this. We're analyzing all these statistics in our algorithm, and we are classifying these kind of traders as toxic or not. And also, we are diverting accordingly with different liquidity pools. We divert to our toxic liquidity pool, we divert to our VIP pool, to our standard pool. It all depends on the scoring and the client behavior.
I know for you, everyone is guilty until they're proven innocent. Bailey, is that the same approach for you?
Definitely not. No. Yeah, we. Yeah, no, it's definitely true, and we're quite lenient when it comes to that because for us, we believe that you need to collect an appropriate sample of data to really prove whether a client's behavior is toxic or abusive. And I think if you apply blanket rules without properly backtesting them, that can actually be a huge risk to the business, not just from a profitability point of view of a certain client. It can be reputational damage. It can be not succeeding in a certain country because you have a certain bias towards traders from that country. So I think it's important how you define those rules and not to have blanket rules without analyzing it properly.
Definitely there cannot be a set of rules that can be applied universally, at least. Us being in the liquidity space, we have, I would say, the luxury to see multiple brokers trading at certain times, being hedged from one broker to another. For sure, markouts are not only enough. Then you have a suspicion that something is wrong. Then you need to find evidence supporting your suspicion. Where are they trading from? They are sitting in Cyprus, but they are trading from London, for example. But honestly, the clients have become much more sophisticated nowadays. I think the manuals for this kind of robots have become very complex, 10, 20 pages, explaining to people how to use them. So it's a challenge, but numbers and maths never lie. So if you have something that is happening consistently, you know that the most likely scenario is for them to take advantage of your technology. So you have to have a deep look at your infrastructure. Are you fully cloud? Do you use physical machines, etc.? Do you get a throttle feed? Do you pass a throttle feed? How do you execute? So it's many things that you have to take into consideration before assigning a flag to a client. So we spend days and days on analyzing data.
Is it mostly eyeballing, or are you using some sort of filters? And well, you said you have an automated scoring system, but for the rest of you?
Yeah, I'd say it's semi-automated. We always have a human in the loop, and a lot of it is very much filtration based. So we'll get there's alerts that go off at a certain level, and then at other thresholds there'll be alerts and reports that are reviewed by a team. Something that is probably going to get mentioned is AI. There's a lot of buzz, I guess, in the industry about using AI in dealing. There's definitely a place for AI and further automation in dealing. But as I kind of touched on before, that's something that needs to be properly back-tested. You can't just go and replace a human with AI and expect it's going to work. It might look pretty, it might sound good to your shareholders and to your management team, but is it actually producing better reports? I can guarantee you that most of the people using AI in that capacity won't be able to actually answer that question. So that's something that I think the industry needs to recognize sooner rather than later. And if they're interested in doing that, invest further in properly back-testing and proving that it's a better solution.
As I mentioned before, multiple factors and data. We analyze data. Every number tells a story. So behind every number, we have a story. We analyze the data. We analyze multiple factors. As you said before, it's not just a single factor or a specific region. You have to confirm in multiple ways that this kind of flow is toxic or not.
I'm just curious, before we move on to the next question, do you still use VAR, or is it mostly liquidity stress testing? Because obviously, for years, there's been a rumor that VAR is dead, so maybe we can confirm or disconfirm it.
Both. Yeah. Simple as that. Yeah, both. Absolutely. Yep. It's non-negotiable that we look at all of these metrics, and we use all of that information to help us draw conclusions.
So how do you manage the correlation of this?
All of this is really only indicative, okay? So you can put any numbers into any sort of model you want and you can produce any output. Actually, again, having a deep understanding of it, rather than just looking at the core numbers, is help. You can sort of put those connections together sensibly, I think.
I'll keep it short. We definitely use VAR, but there's more simple metrics you can use as well.
Also, we see we are using VAR, but there are other metrics that we are prioritizing instead of VAR.
Well, there is the same statistics, garbage in, garbage out. So any model is as good as its data. Also, there are multiple models of VAR, depending on whether you are applying the same weights on the historical data or not. So, as we are also applying a certain degree of the VAR valuation, but that's not our sole formula that we use. Our aim is, first of all, that first we need to pay for the clients, their withdrawals, etc., and the rest will follow. That's the main drive of the company.
Okay, I have a last question, and then we can take some questions. My last question is, if you'd be building a risk management team or dealing desk team today, what would it look like?
It's pertinent because we are, right? So we're building out those capabilities. It's people that have got obviously experience, but people that are willing to come at things with a fresh perspective. And it's people that are maybe from even outside the industry, so that they genuinely are coming with new ideas and new ways of thinking about stuff. So we're not particularly wedded to any kind of particular skill set. It's about having that keen, inquisitive mind and that real desire to try and learn and to move things on.
If you're building from scratch, you definitely need a strong core team to begin with, and you should really focus on the basics first. I think a lot of brokers don't focus on the basics, they jump ahead, or they're so busy because their basics aren't covered that they're just scrambling to deal with ad hoc problems that pop up all the time. So it would be people, procedures, and then the basics of offering a trading service and a market making service as a retail broker.
For me, number one is to invest in good people. Great teams, great results. So number one, team. Number two, invest in your technology, infrastructure, connectivities, great tools to analyze your risk. And everything has to be documented. Documentation, one of the most important things, you have to document everything. Every policy, every limitation, every procedure has to be documented.
Definitely people. There is no need to reinvent the wheel, just improve it. Documentation should be there. Of course, corporate governance is very important in running an organization. Proper risk management controls, first line of defense, second line of defense, third line of defense. That's the job of internal audit, compliance, etc. So technology, people, and I think that what people forget mostly is maths. You need to back everything with science, and a tight portion of it's not mentioned before AI. Is the future. So a certain degree of AI to be incorporated should be placed, but the traditional models I think have been working so far. Take them, improve them, invest in the future.
Fantastic, thank you. Right, we're ready to take some questions. Any questions? Oh, yeah, well, of course. Roman was first, and then you, darling. But yeah, Roman.
To answer this question, you might need to communicate with each other.
That would be difficult.
Let's have a...
Because I'm more or less aware of how the factors the dealers consider when categorizing clients in the retail space. But what would be the top 3 key factors the LPs having in mind when they categorize their brokerage clients?
So it's about understanding the, let's say, first of all, the size of the ticket and the frequency of the ticket that is going to be coming through, because there is no point giving you a 100-ounce feed if you are going to be smashing 1,000 ounces at a time, right? You're set for disaster. So it's understanding at that fundamental level the type of flow that you're going to be sending. Then there's a further discussion, and we can only do this after a little period of time when we've got some proper evidence around is that flow toxic? Is it quite soft? Is it hybrid, right? And then we can further refine it so that you get a tailored feed for every single one of your client types. And then that's the fundamentals, and then there's that constant ongoing dialogue. So that's very, very important, because none of this stuff stays static, right? It changes whether it's hour by hour, day by day. But having that dialogue is absolutely vital for us. So understanding the flow, tag management, and dialogue.
Yeah, when somebody's asking for tags is to do a better profiling of the flow that they are getting. So you might have one client out of 1,000 disrupting the data. So you need to analyze the flow, where it's coming from, how frequent does it come, at what time do they trade, which instrument, whether there is a correlation between one broker to another, is it constant? I mean, if something has been happening for the vast majority of the trades, then something is going on. So the most important is to have a lot of data to analyze and see where this toxicity, if any, is coming from. Though toxicity from one LP to another is different. For example, you have now the trend is for people to trade with spot gold and future gold, which is spread trading, etc. Essentially. So for some LPs, this is toxic. For some others, this is not. So it also depends on how the LP manages their own risk. And from one LP to another, this changes. Do they have a true STP model? Do they warehouse much of the trades in order to accommodate then different trades are coming in? It depends from one LP to another. So I wouldn't say that there are factors that can be universally applied, but there are certain things that are common. Frequency, hours, instrument, markouts is also another indication. There are many things that need to be taken into consideration, but I would say that the first step is to analyze the tags, the sub-IDs that are coming in, and then you are going to take it from there.
I was going to say a very similar thing that what you finished with. It depends on the risk management strategy of the LP. There are some LPs that operate large warehouse books, and in that case, their client profiling will be very similar to what a retail broker is, just on a larger scale. So they care more about what is the profitability of the client in the long term because they're holding the position in the long term. LPs who are hedging more quickly and more standard kind of prime model, they care a lot more about what does the mark-out curve look like in the short term, because that's the time horizon where they're either going to internalize or hedge out, or where their upstream LPs are going to internalize or hedge out. So it really depends on what model your LP is doing. And I think for most retail brokers, at a certain size, it makes sense to work with an LP who complements your risk management strategy. Probably doesn't make sense for them to be doing the same thing that you're doing.
More or less the same for the retail side of you. Again, we're analyzing data, the frequency, the amount of trading, the time of trading, how fast he enter and exit the trade, markout analysis, scoring, as I mentioned before, if high score, low score. Again, more or less the same thing that my colleagues already mentioned.
Well, first of all, it's two questions in one. So first, how would you define the difference between toxic and abusive? And if it's the same across brokers? And the question that is kind of combined would be, mainly because of AI, NCPs, and the ability of trading through these kind of models, how do you see the whole industry going open finance in order to also allow not just the retail traders, but also the whole industry connecting each other in order to allow traders to be more connected, and also this being an issue with the way that you have each setup within the client. What I mean is, if a client for you could be toxic, but for the other one could be like acceptable, and this client is able through AI to know where he can trade, this is gonna be like an issue, you know? So that's why having a more open API across the industry maybe could work in terms of risk management to share those kind of knowledge across the industry. So how do you see it?
Let me start. For us, abusive or toxic clients, for me, it's the same. If someone, each company has its own risk management way. I work with many companies through the years. I saw a lot of setups. I saw a lot of risk approach from different companies through my experience and my career. So yes, the answer is yes. For me, it's toxic. For someone else, it's not toxic. I can tolerate it. He cannot tolerate it. It depends also from company to company, the risk limitations, the risk tolerance, the book of the company, if you can accept this kind of flow or not. But again, a toxic client is the one that is trying to exploit certain things about the flow, the data, the time, let's say the illiquid time period. So yes, regarding your question, if it's good to spread the information with the use of AI, yes, of course. For AI is part of our life lately. So we're going to expect more and more clients to start trading with the help of AI. So retail brokers has to find ways to deal with it and not classify everything as toxic flow.
Yeah, I think for us, the answer is very similar with regards to toxic and abusive flow. I think brokers define those differently based on their internal kind of documentation, I guess. For us, abusive is abusing something very clear within our offering. For example, something like, gap abuse, where they're abusing the negative balance system. Yeah, trading conditions. Whereas toxic is more like abusing something more on a market level. For example, intentionally trying to push in low liquidity times, as an example. With regards to your second question, I think it's definitely an idea that is already being raised within the industry. It's been discussed for a very long time. I think it depends on the quality of data. If the data quality is there to be sharing that information, then it could work quite well. But the risk is that people define toxic and abusive flow differently. So if you're sharing that across brokers, that can become a pretty big issue. So it depends on the data quality and how you filter that data. And there's people who are trying to take that challenge on now. And I think it could work, but we'll see.
But the data has already been shared under the EU regime. I mean, you have the MIFID data, trade repository, where you collect all the trading information. So that information is there. But now to define whether this is toxic, abusive, yeah, it's quite different. I mean, negative balance protection, gaps, going all in on the NFP, for example, or FOMC, right before a major announcement, is quite different. But for different brokers, the definition is different for sure. And now you also need to factor in the execution. There are venues where there is no last lookup. There are venues where they hedge spot gold on CME directly and bear some basis risk. So different execution, different conditions, different definitions. So can it be universalized? No. And I think that even if you shared the data openly, you would expose the brokers to different risks. For example, I would know Edgewater's volumes. Do you want me to know your volumes? Also, there are market makers out there, prime brokers that we work with dark pools. They don't want to have their pricing being advertised on an API. So that's a very challenging thing to do. I think the best way to move forward is to collect data and, as a retail broker, to choose liquidity providers and counterparties that do not use the same sources. Because by adding 1 or 2 or 3 liquidity providers, you might be recycling the same liquidity at the end of the day. So even if you were to distribute some trade activity from one provider to another, you might end up with the same problem. So you have to check who your counterparty is, who they are working with primarily in the background, and then decide how you want to route your flow.
Thank you. I think Kate is looking angry at me already. She's like, rearing to come here and start her own panel. Sorry? Someone's thirsty. Everyone's thirsty. Okay, thank you very much. I mean, if you have any more questions, I'm sure you can be approached, right? So it won't be an issue. So yes, please come and talk to the great panelists that we have here. Thank you.